And silver's at 40, okay, 42, we're almost today. I think silver's going to do a big catch up. And I think while gold continues up, and now it's come up out of its 5-month wide range, 3,500 to 3,200 back and forth, just sleepy as hell, but no real break. And silver gained during that time quite a bit. The spread is starting to favor silver now, meaning what's the better performer? Yeah, right now silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs.
The silver market is sitting on the precipice of what could be its most explosive breakout in decades. Most investors fixate on silver's old $50 peak, but Michael Oliver argues those highs are meaningless in today's debased currency era and that silver's real trajectory lies far beyond them. Oliver's analysis suggests silver could reach $200 per ounce, a target that might seem outlandish until you consider his core argument about inflation-adjusted valuations. Those fleeting peaks near $50 in previous decades lasted mere hours or days at best. When adjusted for currency devaluation and monetary supply expansion over the intervening years, silver would need to trade between $100 to $200 just to match the real purchasing power of those historical highs. The current setup presents a compelling technical picture that Oliver believes is ripe for exploitation. With silver trading in the $40 to $42 range, it's demonstrating classic laggard behavior relative to gold, a dynamic that has historically preceded silver's most dramatic outperformance periods. Recent data shows that over the past 12 months, silver has gained about 40% compared to gold's 38.5% rise, but Oliver sees this as only the beginning of a more pronounced divergence. The key metric Oliver tracks is the gold to silver spread, expressed as silver's price as a percentage of gold's price. This ratio recently dipped below 1% but is now showing signs of breaking higher. If the spread reaches 2% while gold remains flat, silver will need to trade around $70 to maintain that ratio. Before we dive deeper into Michael Oliver's insights on silver's breakout potential, gold's performance, and the shifting dynamics of the monetary metals, don't forget to hit the like button, subscribe to the channel, and tap the bell icon so you stay updated with the latest market analysis.
I think silver is likely between now and the year end, and maybe sooner than that, take out its old dual highs at 50. First off, they're phantom highs, meaning when we were there before, it was very brief anyway, like hours or a few days before it collapsed. But even in real dollar price terms, adjusting for the degradation in the money unit, which goes and increases in supply about 90% every decade, silver would probably be $100, $200 right now just to match those highs. Okay, and then put it another way. Either silver is totally a piece of something you don't want to own, or it's lagged and it's going to catch up. Now, what do I mean by lag? Look at copper. It's above its 2011 high. Gold, well above its 2011 high. Gold miners on Friday, XAU blew out its 2011 highs. GDX made a new high monthly close. Not above the intra-month highs of 2011, but a new high monthly close. And silver's at 40. Okay, 42, we're almost today. I think silver's going to do a big catch up. And I think while gold continues up, and now it's come up out of its 5-month wide range, 3,500 to 3,200 back and forth, just sleepy as hell, but no real break. And silver gained during that time quite a bit. The spread is starting to favor silver now, meaning what's the better performer? Yeah, right now silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge point, okay? Not that it's going to peak there, but that we're going to blast through those old nominal highs and not even pause until we get credibly out above them. And then maybe you get a correction of some kind. Not the end of the bull. But I think that's what we're facing right now. So yeah, momentum said, back in early June, watch out, I'm going to blow out the dual highs at 35. October of last year, March of this year, we dropped all the way down to under 28 in that period of time. And when we came back up through 34, got up to the upper 34s again, momentum said, you're gone. You're going to take off. And I think it's only just begun. I think anybody who pays attention to those old highs as if they're important is illusory. Okay. It's for the reasons you just described. First off, they're ancient, and and look around you at the other base metal, copper, gold miners now. And why is silver? It's a dog? No, it's not. It's just been overlooked. And investors quite often do that. They make mistakes. They underprice things, they overprice things. In the case of silver, it's vastly underpriced. We're also watching something that very few people look at. We keep the spread between gold and silver. The way we do it is we divide an ounce of silver to an ounce of gold and express it as a percent. Silver recently got a pullback low that was slightly below 1% of the price of gold. Well, in our weekend report, we showed going back to 1975, what was the highest reading that silver-gold spread reached in each of those years? And 20 of those 50 years, it reached at least 2%, okay? And in bull trends, like 79 to 80, 2010 to 11, silver was at 3.5 to 6%, the price of gold, okay? Right now, we're, above 1%, and we're pushing up, toward 1.2%. Not far above here, when we run momentum of the spread chart, we're going to get a breakout. And when we get that, we'd expect the spread to also break out. Now, there's a level on the spread at 1.31%. What's that? Over the last 5 years or so, there have been 2 rally highs in the spread that halted at that level. You ever clear that, it's a horizontal range breakout for the spread. And historically, if you go back and look at this performance of that relative performance of silver to gold, whenever silver's beating gold, is surging upward, that converts into net price upside in both metals, meaning silver doesn't outperform gold because gold goes down more than silver. It's always silver outperform gold when they're both going up. Get the point? So while everybody's looking at price, we're also looking at the spread, and it's about to engage in a major breakout as well. And when it does, I think that spread is at minimum going to go to the norm of 2%. Well, heck, that's almost a doubling of its current relative value. I think it'd occur easily by year end. Now, what does that mean? Well, it means, if gold just stood still and silver went to, 2% of it, silver would be $70 or so, But gold will be going up there in that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position is in the silver component of the monetary metals.
Michael Oliver highlights that gold's momentum has remained positive throughout 5 months of sideways trading, despite repeated calls for a correction. Each time gold tested the $3,450 to $3,500 zone, sellers triggered $150 pullbacks, but the metal quickly rebounded to retest the highs. With gold now breaking above $3,500, Oliver views this as the beginning of the next surge phase. He emphasizes that the real driver behind gold's rise is not a single event or shock but the structural expansion of the money supply. M2 continues climbing to new highs, reflecting accelerating monetary growth that debases currency and explains why gold is valued at $3,500 today instead of $35 decades ago. Silver, he argues, is poised to deliver even stronger relative gains. Oliver expects it to decisively clear its old $50 peak and rally to at least $60 to $70 in the near term, with potential for much greater upside as capital flows into the smaller market. Looking at history, he notes that gold has delivered 8-fold gains twice in the past 50 years. If that pattern repeats, gold could reach $8,000, implying silver at $160 per ounce, an outcome he considers entirely plausible. Let's get back to the interview.
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct, it's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly. Like 3 times it got up to 3,500 or 3,450. Right now we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it and they kept getting these $100 and $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. and our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. Because we've blown out the idiot highs, which means, pardon me, those who missed the move, had ignored it and doubted it, will suddenly say, well, golly, I got to be in that, okay? And then you get further gush of money into a fairly small market, which could easily goose it into that zone, and we've got some reasons for that zone. But ultimately, there could be a correction up there. Not the top. So if you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro technical events going on globally and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas like the breaking of the dollar has not been a factor, the dollar index, when you measure versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015 when gold made its low. It's trading around 98 right now. We're trading just below 98. So yeah, it's been above it and below it since then. But 10 years, it's been net lateral. Well, why is gold not net lateral? It's triple and a half. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further wind for gold. Well, we've had the inflation in the sense that the money growth continues. In fact, they're accelerating. The M2 money supply is making new highs now after a pause. That's an ongoing thing. That's why gold isn't $35, it's $3,500, okay? It's not because of any one single event or commodity inflation. And then, so the inflation really is always there. And that's why gold just keeps, over a period of time, it swings up and down versus that metric, but it's upward, just like the decay in the money units. But in the case of commodities, they don't explain. We showed in the weekend report the chart of gold since 2015, and there's this upward plotting action, and then it's accelerating. And you say, well, what caused that? And it wasn't because it was declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, though it will because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. That's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks. Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because I could go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000. You would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know.
Silver is poised to break free from years of being overlooked, with momentum and relative strength now shifting in its favor. Gold, after months of holding steady despite constant doubts, has shown resilience and reset its foundation for further advances. Driving both metals higher is the relentless expansion of the money supply and the growing distortions created by the monopoly over currency, forces that history shows often ignite outsized moves in hard assets. The recurring patterns of the past suggest that what lies ahead is not unusual, but rather a continuation of cycles that emerge whenever monetary confidence erodes. This time, however, the convergence of multiple pressures signals a far more dramatic phase, with monetary metals and miners standing at the center of a powerful and sustained bull market. How might the convergence of monetary expansion, structural distortions, and momentum shifts drive an unprecedented bull market in gold and silver? So stay tuned. If you're interested in real, data-backed insights on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for your support, and we hope you enjoy the video.